This week reminded me of the old Elvis song, "You ain't nothing but a hound dog, just laying around all the time." That's exactly what bonds have been doing, just laying there, not giving us much to get excited about. But here's the thing. Sometimes the most important market movements happen when it looks like nothing's happening at all. And that's exactly what we're seeing right now. Hey there, everyone. Ron Siegel here, certified liability advisor, helping people build wealth through strategic debt management. What a week it's been in the markets. We've got some interesting developments to break down, and I want to give you the straight story on what's happening with mortgage rates and what it means for your clients. Let me paint the picture for you. We started Monday with the 10-year Treasury around 4.2%, and we've been watching this slow creep upward all week. They were sitting at about 4.28%. Now, that might not sound like much, but in the mortgage world, that steady drift higher has real consequences. The MBS market, that's the mortgage-backed securities for those keeping score at home, has been following the same pattern. We hit a ceiling on Wednesday around 100.28, and we've been sliding backwards since then. Not a crash, just a slow leak that's been putting pressure on the rate sheets. And here's what's really interesting. This is exactly what I've been talking about with my clients for weeks. We hit a technical ceiling, and without some help from economic data, we were going to struggle to improve from here. The Fed picture? Now let's talk about the elephant in the room. The Federal Reserve. We've got some big news this week with President Trump nominating Stephen Moran to fill Adriana Kugler's seat as Fed governor. For those who don't know Moran, this guy was the architect of what they're calling the Mar-a-Lago Accord. He's been behind a lot of the economic policies we're seeing, the focus on domestic manufacturing, the strategic approach to trade relationships, and maintaining the dollar as the world's reserve currency. What does this mean for rates? Well, Moran is likely to vote for cuts in the remaining Fed meetings this year, and with CEO confidence showing signs of revival, bouncing from a recessionary 34 reading to a 49 in the third quarter, we're seeing some interesting cross currents. Remember, strategy beats rate always, but here's where my philosophy really comes into play. Strategy does beat rate always. While everyone's obsessing over whether we get a quarter point cut in September, I'm looking at the bigger picture for your clients. What really matters isn't that individual mortgage rate, it's the household blended interest rate. How much money is actually coming out of your client's budget every month? That's what drives wealth building through strategic debt management. I had a client this week, can't give you specifics for privacy reasons, but they were laser focused on getting the absolute lowest mortgage rate. Meanwhile, they had a credit card debt at 24%, a car loan at 8%, and a HELOC at prime plus 1. We restructured their entire debt portfolio, and even though their mortgage rate was an eighth higher than they wanted, their monthly cash flow improved by $800. Now, looking ahead, next Tuesday, we get CPI inflation data, and that's going to be the real test. If inflation comes in hot, we could see rates jump quickly. The markets are expecting some cooling in the headline number, but core CPI is still a question mark. Thursday brings us PPI data, and Friday we get retail sales. Any of these could move the needle significantly. For those floating loans right now, you're playing with fire. The technical picture shows we're sitting right on support levels for bonds. If we break through, there's room to give up about 18 basis points, which translates to real money on rate sheets. So what does this mean for your clients? Here's my take. For purchase clients closing in the next 15 days, lock now. Don't gamble on next week's inflation data. The risk reward just isn't there. For clients in the 15 to 30-day window, this is your decision point. Important dates to circle: Tuesday's CPI, September 5th jobs report, and the September 17th Fed meeting. If you're risk averse, lock and sleep well at night. Longer term closings, you've got time to see how this plays out. Even if rates move higher short term, there are factors that could bring them back down. Remember, suitability beats eligibility every time. It's not just about whether your client can qualify, it's about whether the strategy makes sense for their overall financial picture. And remember to bring me something, this brings me to something I see happening all the time. Realtors. You're dealing with frustrated buyers who think they missed the boat on rates. Financial advisors. Your clients are sitting on the sidelines thinking they should wait for better rates. But here's the reality. We might be looking at mortgage spread compression, that could bring 30-year rates down to 6 and 8% range if the stars align. Scott Besson's target of a 3.9% on a 10-year combined with narrowing spreads could create real opportunities. The question is, are your clients positioned to take advantage when that window opens? Look, I've been doing this since 1983, and I've learned that the best opportunities often come when someone else is paralyzed by uncertainty. Strategy beats rate always. Focus on the total cost analysis. Look at cash flow impact on the household budget. And remember, building wealth is about managing both sides of the equation, assets and liabilities. If you've got challenging clients, business owners with income or asset mismatches, divorce situations, veterans needing specialized programs, these are exactly the scenarios where our certified buyer program and Second Look Advantage program really shine. For more insights, check out ronsiegelradio.com. And if you want to dive deeper into any of these strategies, you can book a discovery call at bookrs15.com. As I've said many times, strategy beats rate always. Have a great weekend, everyone. Talk to you soon.